Hey everyone, and welcome back to Money Journey. For decades, many of us haven't just looked at Warren Buffett as a successful CEO, but as a mentor, the ultimate guide through the often choppy waters of the stock market. His wisdom, gathered over 60 years leading Berkshire Hathaway, has shaped countless investment philosophies, including my own. This past weekend, I tuned into the 2025 Berkshire Hathaway Annual Shareholder Meeting, and with Mr. Buffett announcing he will be stepping down as CEO at the end of this year, that was a feeling that this might be one of the last time we get this unique opportunity to learn directly from arguably the greatest investor of all time in this setting. Among all the insights shared, there was one lesson, one powerful reminder about handling market volatility that truly resonated. It's about detaching emotion from price, something crucial, especially when the market gets shaky. So, today we are going to watch a key clip from the meeting, and then I will share my reaction and why I believe this single lesson is so fundamental to long-term success. Let's dive in.
My question is, what was, in your estimate, Berkshire's earning power in the latest fiscal year? It would be great if you can comment on any significant items that either increased or decreased the earning power as compared to reported net income measures for Berkshire. Thank you.
Yeah, well, I think our underlying earning power was affected negatively here a while back by what happened in the utility field. I think that our earning power is not enlarged by any large acquisitions that come along, but they come along periodically. So we will see something at some point well, could be, on the one that was 10 billion, we would have added to earning power. I mean, why else would we do it? So that's very situational. And of course, it depends so much on what the general market is doing and what interest rates are doing and what psychology is doing. We will make our best deals when people are the most pessimistic. That's been true ever since I was 1930. I was born in 1930. When I was born, things got much more attractive over the next 2 years, and apparently I didn't do anything about it there. But, that was the opportunity of a lifetime, and I blew it by, worrying about the kid in the next crib or something. But over my lifetime, I've had fabulous opportunities sometimes, and they happen because humans are human. And I don't, I'm fearful of all kinds of things. I don't want to try and, be one of the Walendas and walk on a tiny strip between a couple of twin towers or something, or whatever it may be. But I don't get fearful by things that other people are afraid of in a financial way. That the idea that if let's say Berkshire went down 50% next week, I would regard that as a fantastic opportunity, and it wouldn't bother me in the least. And most people aren't. They just react differently, and so it's not that I don't have emotions, but I don't have emotions about the prices of stocks. I mean, those decisions get all the way to my brain, whereas emotions can get bogged down some other place. So Berkshire will increase its earning power over time as we retain money. I mean, we are doing things, making decisions every day. People are working, we're retaining earnings. We will build the earning power, but it won't be coming in any even stream, and it certainly won't be matched dollar for dollar on either the upside or the downside and market prices. But that's what makes it a good business. And, the investment business is that everything isn't properly appraised, and the sillier other people get, the better your opportunities get.
Whoa, okay, let's unpack that because there's so much wisdom condensed into those statements. Buffett starts by saying the volatility we have seen recently, maybe related to tariffs or whatever the news of the day is really nothing in the grand scheme. Think about that perspective. Immediately backs it up by reminding us that Berkshire Hathaway itself, one of the most successful companies ever, has dropped by 50% 3 times during his tenure. And crucially, he notes there was no fundamental issue with the business during those times. The market just panicked. This is the absolute core of the lesson, separating the price of the stock from the value of the underlying business. Now, why is this so important for us as investors? Because emotion is the enemy of good investing. When the market plunges, what's the natural human reaction? Fear, panic, the urge to sell everything before it goes lower. Buffett says, I don't get fearful of things that other people are afraid of in a financial way. He's conditioned himself through decades of experience to see what others perceive as danger as opportunity. Listen to this key line again. Let's say Berkshire went down 50% next week. I would regard that as a fantastic opportunity and it wouldn't bother me in the least. For a long-term investor focused on fundamentals, a market downturn isn't a disaster, it's a sale. It's a chance to buy shares in a wonderful business at discounted price. Selling during a panic driven by fear is how you lock in losses and potentially miss out on enormous gains when the market eventually recovers, and history shows it always as eventually. This mindset perfectly embodies his famous piece of advice. Be fearful when others are greedy and greedy when others are fearful. When the market is dropping and the headlines are screaming crisis, that's the fear, Buffett is thinking about what great companies are now available at a better price. That's the greed, or more accurately, the opportunity. He's not immune to knowing prices are down, but his emotional response is completely different from the average person. His point about needing a different investment philosophy if a 15% drop bothers you is blunt but true. The market doesn't care about your feelings. It will fluctuate. As he says, the world is not going to adapt to you. You are going to have to adapt to the world. Adapting in this context means developing the emotional resilience to stick to your strategy, to trust your research on a company's fundamentals, even when the price is temporarily falling. So, the big takeaway here isn't just don't panic, it's deeper. It's about understanding that volatility is normal, that price drops disconnected from fundamental business deteriorating are opportunities, and that mastering your own emotion, checking them at the door, as he says, is perhaps the most critical skills for long-term investing success. It's the difference between building wealth steadily over time and constantly reacting, often destructively, to market noise. So, that's the powerful lesson from Warren Buffett at the 2025 meeting. Master your emotions, or the market will master you. Remember, short-term price swings often reflect fear and greed, not necessarily business reality. Viewing significant drops in fundamentally sound companies not as crises but as potential opportunities is key to long-term success. What do you think? Is this something you struggle as an investor? How do you try to keep emotions in check during market volatility? Let me know your thoughts and your biggest takeaways in the comments below. If you found this valuable and want more insights into investing strategy, market analysis and lessons from the great, make sure to hit that like button and definitely subscribe to the channel so you don't miss future videos. Thanks so much for watching and I'll see you in the next one. This video is for informational purpose only and should not be considered financial advice. Always conduct your own research and consult with a qualified financial advisor before making any investment decision.